Hello everyone and welcome back to the channel. So before I start the explanation, I want to remind all of you that my trading group chat is ready for you guys to join. The link is down in the description and it's absolutely free to join. And here you can see that one of my members was able to make an easy $111 profits by following my trade alert on NFLX. And if we go into the trade callout tabs, you can see that I alerted NFLX at 8:30 at the opening bell, and I entered the trade at around 8:47 because I was waiting for a pullback to happen, and roughly 5 minutes later I exited the trade for a quick and easy $75 profit. So this is just a little snippet of what the trade chat is going to be like, but like I said, if you want to join, it's absolutely free and the link is down in the description. So now back to the video. So the topic of today's video is going to be credit and debit spreads and what's the difference between both of them. So the reason why I thought this was a good idea to make a video on is because not only is it good to know how to trade different option strategies, but also because there's a really big misconception between both of the spreads, and in almost every group chat that I've been in, I've always seen people confuse both of them, and that leads them to losing money. So first of all, what's a spread? So a spread is basically when you buy and sell the same number of options with the same expiration, but each with a different strike price, and they're generally used to lower risk. However, by doing so, you also limit your potential profit. Spreads are viewed as the safest way to trade options because of how much you can lower your risk. So what are credit spreads? So do you ever wonder where the money you lose on an option goes to? Well, generally they go to the person who sold you the option as an opening trade. And in a credit spread, that's exactly what you're doing. So in a credit spread, you are buying an option and selling an option that is closer in the money than the one you sold. And the key difference here is closer because in a debit spread, it's further out in the money, and that's the main difference between both spreads, and we'll get into that later. So the way you profit in a credit spread is when the underlying price of the spread decreases, and that might sound confusing at first because usually you want the price of an option to go up, but you'll understand later. So in a credit spread, it's important to note that you don't have to worry about time decay because here you want the price to actually decrease, so time decay is actually on your side, which is good. So in this example, I will be using NFLX as the credit spread. So if I were to buy a 370 call and sell a 367.5 call, I would receive a credit of $105. This credit is the max profit that I would be able to make. However, I would only get the $105 if the options are worthless at expiration. However, because of time decay, the options will gradually decrease leading up to expiration, and you can take profits without having to wait until the day of expiration. So the way you calculate the max loss on a credit spread is you take the difference between the two strike prices and subtract the premium you received. So in this case, it would be the 370 strike minus the 367.5 strike, and you subtract the credit you received, which is 105, and you would get and you would be left with 145. So to recap this trade, the most we could lose is $145, and the most we could make is $105. In a debit spread, you are doing the opposite as in a credit spread. You are buying an option and selling an option that is further out of the money than the one you bought. And that's the main difference between the debit and credit spreads. How far away is the option that you sold compared to the one that you bought. So debit spreads are used to reduce risk or to trade higher priced options with less capital. So the maximum loss on a debit spread is what you paid for the spread, and that happens if at the end of expiration both options expire worthless. And the maximum gain that can be calculated by taking the difference between the two strike prices and subtracting it from the debit that you paid to buy the options. So now I'm going to go ahead and explain another debit spread example. So we're going to be using NFLX again to keep things simple. So if I were to buy the 362.5 option and sell the 367.5 option, I would be creating a debit spread. And the price I would pay for the spread would be the difference between the two options, which comes out to be $158. See, and that would be the most I could lose on this trade. So in most cases, if I were to trade the naked option of 365 or 362.5, it would be quite expensive. As you guys can see that it's trading around roughly around $11, which comes out to be $1,100. But by creating this debit spread, we reduced the total cost of that trade to $158, and overall it's also reducing the risk in the process. So the most I can make can be calculated by taking the difference between the two spreads and subtracting the debit that I paid. So in this case, it would be 365 minus 362.5, and you subtract the debit that you paid, which is $158, and you get $92. So the most we could make on this trade is $92, and the most that we're risking on this trade is $158. And you guys can see that by creating a debit spread, we were able to lower the total cost of the trade, but we were also limiting the potential profit that we could make. So that's pretty much it for the difference between the debit and the credit spreads. I hope this video was useful, and take it with a grain of salt. If you guys choose to trade these options, do take in mind that they can be extremely profitable if you plan them out right. And I will be making a further video explaining different type of strategies within the two types of spreads, because there's obviously multiple ways you can trade debit spreads and credit spreads. But that's pretty much for this video. Thank you guys for watching, and I'll see you guys in the next one.